Can housing become affordable again without breaking the economy? The uncomfortable answer is this. Housing can become affordable again, but not without someone losing. Prices don't fall in isolation. Payments don't shrink without consequences, and policies don't change incentives without shifting wealth. So, before we talk about solutions, we need to be honest about one thing. What actually breaks when housing becomes cheaper? Because every proposal you hear avoids that question on purpose. Why real housing solutions are politically impossible. Let's start with the part no housing debate likes to say out loud. About 65% of U.S. households own their homes. For most of them, that home isn't just shelter, it's their largest asset, their main source of net worth, and often their retirement plan. That single fact defines the entire housing crisis. Because making housing affordable again means one thing: prices must stop rising or fall. And falling prices don't feel like a solution to homeowners, they feel like a loss. That's the political trap. Voters say they want affordable housing, but most voters are homeowners, and homeowners overwhelmingly oppose anything that threatens home values, even if high prices are what locked everyone else out. This is why housing is treated differently from almost every other market. Stocks can crash, tech companies can fail, entire industries can reset, but housing prices are quietly protected. After 2008, policymakers learned a hard lesson. Large housing price declines destabilize the entire financial system. When home prices fall, household balance sheets weaken, mortgage defaults rise, banks tighten lending, construction collapses, local tax revenue shrinks. Housing doesn't just affect buyers and sellers. It sits at the center of credit markets, pensions, and municipal finance. So policymakers face an impossible choice. If prices keep rising, affordability collapses. If prices fall meaningfully, financial stability is threatened. That's why most solutions avoid prices entirely. Instead, governments boost demand. First-time buyer credits, down payment assistance, subsidized mortgages. These policies are politically safe. They don't force prices down. They don't upset existing homeowners. But economically, the outcome is predictable. When supply is constrained, increasing demand raises prices. Every subsidy gets capitalized into higher home values. Buyers feel helped, sellers get paid, affordability stays broken. This isn't ideology, it's basic supply math. And the alternative, allowing prices to fall, is politically radioactive. A true affordability reset would mean millions losing equity, recent buyers going underwater, housing no longer functioning as a guaranteed wealth builder. That's a cost no politician wants to own. So housing policy drifts into paralysis. Lots of talk, minor tweaks, no structural change. Not because solutions are unknown, but because real solutions require losses, and losses have voters. In the next chapter, we'll look at why almost every buyer-focused housing policy makes affordability worse, not better, and why supply-side fixes face even deeper resistance. But income alone doesn't explain why affordability broke this badly. Because even if wages had kept up better, they still would have run straight into a second wall, supply that stopped responding years ago. Why buyer help always makes housing worse. When housing becomes unaffordable, the political instinct is always the same. Help the buyer, lower the down payment, offer tax credits, subsidize mortgages, expand government-backed loans. On paper, it sounds compassionate. In reality, it does the opposite. Because housing isn't broken due to lack of buyers. It's broken because there aren't enough homes, especially where people actually want to live.
When supply is tight, every dollar of help doesn't go to the buyer, it goes to the price. This isn't theory. We've watched it happen repeatedly. After the pandemic, mortgage rates were pushed below 3%. Monthly payments dropped dramatically. Demand exploded overnight. Did housing become affordable? No. Prices surged at the fastest pace in modern history. Lower borrowing costs didn't create affordability. They pulled future demand forward, bidding up a fixed supply of homes. The same logic applies to buyer subsidies. If you give a buyer $10,000 in assistance, they don't magically gain purchasing power alone. Every other buyer gets the same boost. Sellers raise asking prices. Builders raise prices on new homes. The market absorbs the subsidy. Economists call this capitalization. Voters experience it as disappointment. This is why first-time buyer programs almost never reduce prices. They increase competition for the same limited inventory.
And worse, they trap buyers into higher leverage at peak prices. Many recent buyers didn't win, they stretched. Higher prices, larger mortgages, longer terms. Affordability looked better on paper until payments reset, taxes rose, or insurance spiked. Buyer-focused policies feel helpful because they act fast, but they avoid the real constraint, supply. Which brings us to the uncomfortable truth. Every serious housing fix must increase supply where demand already exists, near jobs, near infrastructure, in high-opportunity cities, and that's exactly where resistance is strongest. Local homeowners oppose density. Zoning blocks multifamily housing. Permitting delays stretch years. So instead of fixing supply, policymakers stimulate demand again and again, because demand-side solutions don't threaten existing homeowners. They protect prices. They protect equity. They protect votes. But they also guarantee that affordability never truly returns. Housing becomes a ladder you have to climb faster every year, not because buyers are failing, but because policy keeps pushing prices higher while pretending to help. In the next chapter, we'll confront the hardest part of the problem: why increasing supply at scale isn't just difficult, it directly conflicts with how housing creates political and financial power.
Why supply fixes trigger political revolt. At this point, the problem sounds simple. Build more homes, increase density, let supply respond to demand. So why doesn't it happen? Because housing isn't just shelter, it's power. In most U.S. cities, homeowners are the dominant voting bloc. They show up, they organize, and they vote in local elections that decide zoning, permits, and development rules. Renters don't. And the incentives are brutally clear. For a homeowner, new housing nearby isn't neutral, it's perceived as a threat. More supply means slower price growth, less scarcity, less guaranteed equity appreciation. Even if prices don't fall, the rate of increase might. And for a household whose largest asset is their home, that feels like loss. This is why housing policy breaks at the local level. Federal leaders can talk about affordability. State governments can pass broad reforms. But the real gatekeepers are cities, counties, and planning boards. Zoning hearings, environmental reviews, neighborhood councils. Each step offers a veto point, and every veto favors the status quo. A single homeowner can delay a project for years. An organized neighborhood can kill it entirely. Not because the project is unsafe, but because it changes neighborhood character. That phrase hides everything. It means no apartments near single-family zones, no height increases, no duplexes, triplexes, or small multifamily buildings, no density near transit. In other words, no supply where demand is highest.
The irony is that many cities claim to support affordability, just not here. Build somewhere else, farther out, away from jobs. But pushing housing outward increases commute times, infrastructure costs, and emissions, and still doesn't solve affordability where wages are highest. This is why housing shortages persist even in strong economies. The market wants to build. Capital is available. Demand is obvious. But permission is rationed. And permission is political. Over time, this creates a feedback loop. Rising prices make homeowners wealthier. Wealthier homeowners gain more political influence. They tighten supply controls to protect their gains. Each cycle makes the next one harder to break. Housing stops behaving like a normal market. High prices don't bring more supply. They bring more resistance. And that's the core paradox. The people most harmed by high prices, renters and future buyers, have the least power to change the system, while those who benefit from scarcity, existing owners, control the levers. Any real solution must break this political dynamic, and that's why most solutions never leave the talking stage. In the next chapter, we'll confront the most uncomfortable question of all: what a real housing solution would actually require, and why it's politically almost impossible to implement. What a real housing solution would actually require. If housing is broken by design, then the fix can't be cosmetic. A real solution wouldn't be subtle, it wouldn't be popular, and it wouldn't be painless. It would require changing who housing is for. First, prices would need to stop rising faster than incomes. That doesn't mean a crash, but it does mean giving up guaranteed appreciation. For decades, housing has delivered something unnatural: high returns with low risk, protected by policy. A real fix would remove that protection. Second, land would need to be used, not hoarded. That means policies that punish underutilization and reward building where demand exists. Land value taxes, strict vacancy penalties, eliminating tax advantages that favor holding over producing. All of these push the same lever: use it or lose it. But they all hit the same group: existing owners, investors, local voters. Third, zoning would need to change at scale. Not pilot programs, not optional density bonuses, not case-by-case approvals. By-right construction, medium-density housing legalized broadly, near jobs, near transit, near opportunity. This isn't radical economics, it's basic supply logic. But politically, it's radioactive, because it removes control from local gatekeepers and hands it to rules. And rules don't respond to pressure. Fourth, housing would need to be definancialized. Not eliminated as an investment, but stripped of its status as a protected asset. That means fewer subsidies to buyers, less leverage for speculative ownership, tighter rules on institutional accumulation. When governments signal that prices must never fall, capital floods in. A real solution would reverse that signal. And finally, the transition would need to be slow. Fast crashes destroy balance sheets. They trap new buyers underwater. They freeze credit. A functional system stabilizes prices over time while letting wages catch up. That path exists, but it demands something democracies struggle with: telling a majority of voters that their biggest asset will no longer be guaranteed to outperform the economy. That's the wall. Every serious solution runs into it, not because the math is wrong, not because the data is unclear, but because the political cost is immediate, while the benefits are long-term and mostly accrue to people who don't vote yet. So instead, governments choose safer moves: demand-side subsidies, tax credits, grants, cheap credit. Policies that look helpful, but quietly push prices higher. They don't solve the problem, they manage the optics. And that's why housing remains unaffordable. Not because we don't know what to do, but because doing it would require admitting that housing can't be both a universal human need and a risk-free wealth engine. One of those has to give, and so far, every system has made the same choice.
The trade-off no one admits. By now, one thing should be obvious. The housing crisis isn't unsolved because we don't know what to do. It's unresolved because the consequences of fixing it are politically and economically dangerous. Every serious solution runs straight into a trade-off no one wants to admit. Housing affordability and economic stability are no longer aligned. For most of the 20th century, they were. Homes were places to live. Prices tracked wages. Construction responded to demand. But over the last 5 decades, that relationship quietly broke. As productivity growth slowed and wages stagnated, advanced economies needed a new way to maintain growth, stability, and household confidence. They found it in assets. Housing, in particular, became more than shelter. It became collateral. It became retirement. It became a psychological safety net. Rising home values replaced rising incomes. And once that happened, affordability stopped being a social goal and became a systemic risk. Because when home prices fall, the damage doesn't stay contained. A 15 to 20% decline doesn't just help first-time buyers. It instantly rewrites millions of balance sheets. Recent buyers go underwater. Banks reprice risk. Mortgage-backed securities lose value. Credit tightens, not just for housing, but across the economy. This isn't theory. We've seen it. In 2008, falling home prices didn't just correct excess. They triggered a global financial crisis because housing had already been financialized. And the lesson policymakers absorbed wasn't housing shouldn't be financialized. It was prices must not fall again. That lesson shaped everything that followed. Low rates, quantitative easing, mortgage guarantees, emergency interventions. Every downturn reinforced the same rule: protect housing prices at all costs. Once that rule is in place, true affordability becomes incompatible with stability, because affordability means lower prices relative to income, and lower prices mean losses, real ones, not just on paper. So instead of fixing the problem at the root, the system learned to manage it. Supply constraints were tolerated, zoning battles dragged on, approval processes remained slow and uncertain, because constrained supply props up prices without triggering an explicit crash. At the same time, demand was stimulated, but carefully. First-time buyer credits, down payment assistance, subsidized mortgages, policies that look like help, but don't change the math. They don't increase affordability, they increase purchasing power. And when supply is fixed, increased purchasing power only does one thing: it raises prices. That's why affordability never improves, even when governments spend billions trying. Because those programs aren't designed to lower prices. They're designed to prevent them from falling. This is the trade-off hiding in plain sight. If you build enough housing in the right places, prices fall. If prices fall, leverage stops working. If leverage stops working, asset-based growth breaks. And when asset-based growth breaks, economies that depend on it slow sharply. So policymakers face an unspoken choice. Do you want cheaper homes? Or do you want stable banks, predictable tax revenue, and a system that doesn't seize up during downturns? Modern economies have already answered that question. They chose stability. That's why supply reform is always partial. Upzoning here, pilot programs there. Just enough to say something is being done, never enough to move prices meaningfully.
because meaningful success would force a reckoning. Housing would stop behaving like a protected asset class and start behaving like a normal good. And that transition is dangerous, not because it's morally wrong, but because the system isn't built to absorb it. So affordability is postponed, not denied outright, not rejected publicly, just delayed indefinitely. Each generation is told the same thing. Prices are high, but the market will fix itself. Just save longer, move further out, wait for supply to catch up. But supply isn't catching up, because catching up would work, and working is the one thing the system cannot afford. So if housing doesn't become affordable by accident and can't be fixed without consequences, the real question isn't whether we know the solution, it's whether we're willing to pay what it would actually cost. What a real solution would actually require. At this point, it's tempting to believe there must be a clever workaround, a policy that lowers prices without hurting homeowners, a reform that boosts supply without angering voters, a financial tweak that restores affordability without destabilizing the system. But when you strip away the slogans and run the math, every real solution demands one thing in common: someone has to lose. There are only a few levers capable of realigning housing affordability at scale, and none of them are neutral. Sustained income growth far beyond historical norms. In theory, the cleanest fix is simple. If incomes rise faster than housing costs, affordability returns without prices falling. In practice, this requires something the modern economy hasn't delivered in decades. Real wage growth at the median would need to run well above 3% annually, not for a year or two, but for a decade or more. That kind of growth only happens with sustained productivity gains, tight labor markets, and bargaining power shifting back to workers. It also requires that those gains reach the middle, not just the top. This isn't impossible, but it's not something housing policy can create. It's a structural economic transformation. And betting housing affordability on that outcome is less a plan than a hope. Large, real price declines, not just stagnation. The fastest path back to affordability is also the most disruptive. Prices fall, not slowly, not after inflation, actually down. To restore historical price-to-income ratios, national prices would need to drop on the order of 20 to 25%, and much more in high-cost metros. That would help future buyers immediately, but it would also impose losses on current owners, especially recent buyers with high leverage and little equity. Negative equity wouldn't be an edge case, it would be widespread. Banks would tighten lending. Transaction volume would freeze. Local governments would see tax bases shrink. This is why price declines are rarely engineered. They happen when something breaks. And when they do, the damage spreads well beyond housing. So, while this path works mathematically, it's politically radioactive. Aggressive overbuilding for a decade or more. The solution most people agree with in theory is supply. Build more housing. But the scale matters. Closing a multi-million unit deficit doesn't happen with a few strong years. It requires building well above historical averages, across regions, price points, and economic cycles, including during recessions. That means zoning reform that actually allows density, faster permitting with less uncertainty, infrastructure investment in high-demand areas, labor force expansion in construction, financing structures that don't collapse when rates rise, and, most importantly, political consistency. Builders don't build through downturns unless risk is backstopped. Historically, that has never been sustained long enough to erase a national shortage. Even if it were, affordability would improve slowly, unevenly, and with long delays, not fast enough to help the people priced out today. Structural demand reduction. The uncomfortable path. There is one more way affordability returns. Demand weakens. Lower population growth, lower household formation, out-migration from high-cost regions. This path doesn't feel like a solution because it isn't. It restores affordability by shrinking opportunity. Prices stabilize not because supply improved, but because fewer people can compete. It's affordability through constraint. And it comes with its own costs: slower growth, aging demographics, and reduced dynamism. The common thread. Every real solution forces the math to change, and every forced change redistributes pain. That's why none of these paths are pursued at full strength. Instead, we get partial measures. Enough intervention to prevent collapse, not enough to restore access. Enough reform to signal concern, not enough to shift outcomes. Housing doesn't become affordable again because doing so would require choosing who absorbs the loss. And modern economies have already made that choice. They protect stability first, asset value second, access last. So when people ask whether housing will ever become affordable again, the honest answer isn't yes or no, it's conditional. Affordability returns only if the country accepts a path that forces the numbers to realign and accepts the consequences that follow. Until then, the system will keep doing what it's designed to do. Not crash, not heal, just function for those already inside. And that's not a failure of economics, it's the result of choices we've already made.
If this video felt uncomfortable, that's the point. Housing doesn't stop working because of one bad policy or one bad year. It stops working when access quietly breaks, and we keep pretending it's temporary. This channel isn't about predicting crashes or selling easy answers. It's about understanding where the math no longer works and who pays the cost when it doesn't. If this kind of analysis helps you see the system more clearly, consider subscribing. New videos come out twice a week, each one building on the last. Thanks for watching. I'll see you in the next one.